Good evening, everybody. We're getting ready for our free option training for this Saturday. So we're going to do a little bit of warm-up in this session. A lot of people, when we mentioned doing spreads, the typical answer is, oh, they're too difficult and I don't understand them. And that's where we're going to try to clarify things tonight, because spreads are very simple. So starting from the beginning, what is a spread? A spread is a position entered by both buying and selling an equal number of options of the same class on the same underlying security, but at different strike prices or expirations. Now, we're going to cut out expirations because all the spreads that I recommend are for the same strike price, not the same strike price, same expiration date. So some people like to do a spread where they buy one month and sell another. We're not going to get that difficult. And the reason we don't get that difficult is just like the whole concept of candlesticks. The more simple we can keep it, the more effective your investing is going to be. When is spreads most effective? When your upside potential is not all that excessive, and that's usually going to be related to the kind of the slower moving stocks, Microsoft's, 3M, but your probability factor is extremely high that it's going to be moving in a specific direction. So even though the magnitude of your return in the stock price move isn't all that great, doing a simple spread can enhance that dramatically. Because we can analyze the price movements with a much higher degree of accuracy using candlestick signals, this allows us to put on different strategies, with the spread being one of them. Now, the reason spreads are so effective is they got three major advantages. One, you've got less money exposed to a market risk. Two, the percentage return is greatly enhanced for a much lower target price. And three, the break even is much lower. Most people will say, or when people think of options, they think, oh, this stock's going up, I'm going to buy the calls. Well, that may not be the most effective trading strategy. As a matter of fact, only about 20% of the time is it the most effective trading strategy. The spreads are very easy to use, and the way you use spreads effectively is using the math. So where do you use spreads? Well, sometimes if you've got a price move that's excessive, or let's say you just had a good price move, good profits, and it looks like it's getting a little bit dicey, but it might still have some more upside. Well, the best thing to do would be take off those profits, put that in your account, and then if you think there's more upside, you might put a spread on with less money exposed, that if it continues up in a higher risk area, you're still going to make a good percentage return. If it fizzles, you're probably not going to lose a whole lot of money putting that spread on. So we're going to be going through these type of factors on Saturday of when do you put on a spread. Sometimes if you have a stock price that skyrockets and you're thinking, man, I don't know, it looks like it's going to go up further, excuse me, but I don't know whether I want to put my money at risk. Maybe putting on a spread makes that much more effective or much more reasonable. Oh, I read the wrong title here. What are the disadvantages of a spread? Your upside potential is limited. So if you're buying a spread that has a $50 and $55 strike price, the maximum you can make is the total or the gross of $5. So if you spend a spread, if the stock goes up 40 points, you're still only going to make that $2 now goes to $5. And that's what the greed factor of most people kill themselves with is, I said, I don't want to limit my upside. What if this really skyrockets? Well, unfortunately, a stock that really skyrockets are maybe 1% of the time. There's a lot of times where you're going to make some very good money on a stock that's just going up moderately. Oh, Jim, I do not know the answer to that. Okay, Bill says yes. All right. Now, there's another disadvantage to a spread. Let's say you put a spread on a stock, and then all of a sudden it skyrockets. Well, let's say your cost was $2, and you were hoping for it to go to $5 over the next 2 weeks. Then all of a sudden, in the next 2 days, it skyrockets up 14 points. Well, your spread, because of the difference in price of those two different options, your spread might be sitting at $1.80 for a while because of the vast movement of those the prices of the options. So that's one disadvantage. But the way you rectify that is, one, your spreads shouldn't be very far out in the future. Mine are usually somewhere 2 to 3 weeks. And two, you can just sit on it, and as long as it stays above your strike prices, it's eventually going to go to your $5 profit. Okay, yes, true. Yeah. So there's your answers there. And I can't remember what the feasibility meant. So here's the advantage we have with candlestick analysis. We can pretty much get an accurate read on the direction of a move. We can also see on different pattern and signal breakouts the timeliness of the move, and based upon the type of signal or pattern, we can also see what the magnitude of the move might be. So that allows us to put on different strategies. So if we see something like this, where we've seen gap up, kind of a J-hook move, if it trades positive, well, it's already had a hefty move. It's getting up toward the overbought area, but out through the 50, you can still have more upside. Might not want to be buying calls up here, but might be putting on a spread. Again, much less money exposed to the trade. And did I do this? Oh, and here's another thing. Here's another disadvantage of spreads. The mechanics of a spread is that if you put in an order that you want to buy the 20s and sell the 25s, I'm just picking out numbers. Well, if one side has good volume or good open interest and the other side doesn't, remember what the mechanics have to be. They have to have buyers and sellers at the same time on both sides. So if the volume and the open interest is very low, you just pass up because you're not going to be able to put that spread on. So here's my timing for buying options. If it's about 3 to 4 weeks out, I'm more apt to buy just straight out calls and puts. If I'm going to put on a spread, I want it to be somewhere around 2 to 3 weeks out. Again, the reason for that is if a price moves too fast, the cost of your spread might go down even though the price move went up or the stock price went up because of the movement of both sides of that spread. And then you have to sit and wait for it to get closer to expiration date for it to get toward the maximum price. And then, 2 to 3 weeks out, I do the debit spreads. If you're trying to find consistent money, not big money, but consistent money, I usually wait till the final week, being able to see what direction a price is moving and how much premium there is in the options, put on a credit spread. You don't make a lot of money, but the probabilities of making money are extremely good. So here's the benefit of a spread. If I see a stock trading at 50 and the target is 55, if you're buying, in this case we did it around December calls for $2.50 and it hits your target of 50, well, your 250 goes to $5 where you made a $2.50 profit, 100% gain. And to break even on that trade, the price had to go to 52.50. So if it never got to the 55, it has to get to the 52.50 to get your 250 back. Now on the other hand, if the stock is at 50 going to 55, if you buy the December 50 calls for 250, and let's say you could sell the December 55 calls for $1, that means you're putting out $2 out of pocket and you're bringing in $1 back into pocket. So your net cost on that trade was $1.50. Now if it goes to your $55 price, or so your option price now goes to $5, you've made $3.50. So instead of making 100% profit, now your percentage gain is 233%. And to break even, you only had to go up to 51.50 instead of 52.50, which is might be a significant percentage move for that stock. So irrelevant decisions are how much time to expiration and which strike price. This is for all option trades, or is there a combination of those two? What happens if it doesn't go to 55? All right, let's go back to the first one. The first one. If you bought those calls at $2.50 and the stock was trading at 50 and the price went to $53, what's the price of your call to sell it? It's going to be $3. So you put in $2.50, you're selling it for $3, you made 50 cents. So your maximum is going to be $5 if it goes to 55. You would lose money if it went to 52.40. Well, when you sell out, you're going to get $2.40, and you lose all your money if the price of the option is below 50 on expiration day. There you go. Chad, let me, when I get to one of the charts or one of the pricing pages, I'll show you. And it's like anything else. You've got a bid ask. It just be like selling stock. You're going to be selling it closer to the bid side. You're buying closer to the ask side. And the options are just the same. There's a bid price and then there's an ask price. So what, and we'll get to that here in a second. Okay, so who was asking that? Oh, what happens if it doesn't get to 55? 55 is your maximum profit. Let's go to the spread. You're buying the 50 or selling the 55. So if it goes to 55, that's where your maximum profit's going to be. Because on expiration day, your you have $1.50 in the trade. On expiration day, you're going to be selling those calls that you paid $2.50 for $5. Now, the ones that you sold for $1, what are they going to be worth if the stock's trading at 55 on expiration? They're going to be worthless. That's zero. So you put in, you've got $1.50 to put on that trade, and at the end of the trade on expiration day, let's say it's trading at 55, you're selling your calls for $5, and these are worthless, so you've got $5 back in your pocket. Now, if it goes to 60, what happens? Well, the calls that you bought on the 50s are now worth 10. So you're going to sell those for 10. But your 55s are now worth $5. You have to buy those back. So you're buying those back for $5. So your net difference is still the $5. Selling 10 or selling at $10 and having to buy back the others for $5. Now, obviously, anytime you make a decision on what type of spreads are tricky in a current volatile market. They are a bit easier to execute when, well, not necessarily, Dave. There's always a price, and I'll show you that. So this is your first criteria. Which way is the market going? Are you buying bull spreads here? Maybe buying put spreads here? Buying bull spreads? So obviously, part of your decision when you're putting on a trade is which direction is the market going. The next decision is, what is the price likely to move based upon our pattern? How far is it going to be up potentially in 2 weeks, 4 weeks, 6 weeks? And those we've got some calculated advantages of seeing what this pattern might be. There's a J-hook pattern setting up right at the breakout level. If this is wave 1, maybe wave 3 is going to take you up into this range. So if I've got something like this, which we did a while back, at that time the March 1700 calls were trading for $9.30. And we expected it bouncing up off the 50, buying them right in here, that it could go up to the 1730 level, the 200-day moving average. So if we bought the calls for $9, and then they went to 30, well, obviously you made whatever that is, 21 bucks. So this is where the spread versus a straight call position, you want to use the math and the risk. So our risk factor was we expected it to go up here. Now, if we bought the calls and they went from $9.30 to 30, made $20.70 or a 220% profit, not terribly bad. But at that time, you could buy the 1700s, 1710s for $1.80. So what did that do for us? That meant all the price had to do was go to 1710 to have that spread price go from $1.80 to $10 or an $8.20 profit to make a 455% profit. And remember, instead of having to go to 1730, all it had to do was be in the right direction and go to 1710. So the equivalent to that would have been that if we bought those calls at 930 to make the same amount on that spread that only had to go up to 1710, that stock price now had to go not only to the 200, but it had to go up to this level to make the same profit percentage as what the spread would have done. Now I've got my own parameter that if I'm buying a $5 spread, meaning a 45 selling the 50s, I don't want to pay any more than $2 for it. On a $10 spread, I don't want to pay any more than $10. So some people will ask, well, shoot, even if you paid $2.50 for it and it went to $5, isn't a 100% profit good? The answer is yes, but you also got to remember you've got risk factor, you've got market risk, and not every trade's going to work. So you want to put on a trade where your potential is going to be at least more than half, so that over the long run you're still making money. Anyways, that's just my parameter of putting on a trade. So what we're going to be doing coming up is, if we can see a fry pan bottom, what is the best strategy? Well, I might be buying calls right here, and I might be buying a spread up here, because a spread up here isn't going to be very expensive. And if the price does move up there after paying for an inexpensive spread, that if it starts making money, obviously we're already making money on the calls. So we can take a pattern that we recognize, a fry pan bottom, and we know what the expected results should be, strategies on here that dramatically improve your profitability with little money exposed up at these rates, or at these levels. So I might be buying these calls right here for $4, but I might be buying a spread up here for a net of 80 cents, that if it does do what it's supposed to, that 80 cents goes to $5. And we can do that continuously moving up. So the further we come up here, a lot of people say, well, could we be buying the calls here? Looks like a J-hook pattern. Well, you've already had a tremendous move. You mitigate your risk by putting on a spread up at these levels. That if it does go higher, it's still making a good percentage return. Or your timing factor is that if you see this open positive, we know we could be putting on trades immediately, knowing what to expect because of our pattern breakout. So if we've got J-hook type patterns, we also have the calculation that if wave 1 and wave 3 are approximately the same, might say, all right, instead of just buying calls right here, maybe I'm buying a spread that from here to here for much less money, but the magnitude of return will be much greater because we can expect the price to move up to those levels. Do you always buy the spread all at once, or do you sell the long option a day or two after buying? No, I usually put the spread on all at one time. Now you can do a staggered spread. Obviously that takes a little bit more calculation, and it has to move in the right direction. So if I was buying, I'm going to just pick out a figure, I can't even see the numbers. But let's say I'm buying the 10s right here for $2, and I could sell the 12s for, I'm going to make it this, I'm just going to sell the 15s for 60 cents. So I've got a net of $1.40 in here to eventually go to $5. Now, if I'm real confident, if I see the market's moving in the right direction, maybe I buy the 10s for $2 in the morning, and it continues to trade up during the day. But at the end of the day, instead of selling the 12s for, what I say, 60 cents, maybe I get 90 cents for it. So now my net, instead of being $1.40, is $1.10. So obviously, the magnitude of that return is going to be much greater, going from $1.10 to $5 versus $1.40 to $5. Now, the only disadvantage, or the only calculation in there that you got to also realize, is that when you sold the whatever I said, 15s, your 10s are already starting to produce a profit, and you're continuing the trade. So you could have sold your 10s for a profit. So that also has to be built into the calculation. Is your first leg of a bull call spread in the money? That depends on each person's risk-reward factor. Depends on how conservative or how aggressive you want to be. Now, if I'm buying something like this, where I'm buying the calls, well, obviously my spread at this, expecting a big move coming out of a fry pan bottom, these are way out of the money instead of in the money or at the money. Let's see. All right, so on something like this, where you just break out at 80, 81, and it could go up here to, say, 85. Well, that's not a huge percent price move. What do you think the percentage probabilities are? Probably pretty good coming out of this pattern. So instead of buying the calls, you might be paying $2 for them for the, let's say the 80s. I'm just picking out numbers. And if it goes up here, that $2 goes to $5, or you made 150%. On the other hand, if you bought the 80s and sold the 85s, instead of having $2 into that cost, maybe you're at $1.20, which definitely magnifies the returns. You have less money at risk, and your break even is much lower. How do you handle monthly options on a stock? Daryl, I don't understand the question. How do you handle monthly options on a stock? Rewrite that more specific. All right, so here's what, this is sink or swim. Oh, here's what I was going to do. I was going to buy the 81s and sell the 83.5s. And that was, so 83.5 is right here. 81 is right here. So, spreads on monthly options. I don't understand. Yes, you can do spreads on the monthly options. That's usually you go with the monthly options because the volume is much greater. So, Daryl, I'm still not understanding. Yeah, it doesn't matter what spread you're using, as long as you got enough volume to get in on both sides. Now, if I'm ready to buy a spread and the monthly expiration is 4 weeks away, well, that's too far away for me to put on a spread. So maybe I'll look at a spread that expires, a weekly spread that expires 2 weeks out. But once again, another factor that you have to take into consideration is what is the open interest, what's the volume? Because if the volume's too small on the weeklies, you're not going to be able to have the traders buy one side and sell the other side at the same time because they may not have enough trading at the same time. Or that's a whole different story. Sometimes you're better off buying or selling a put spread, not buying a put spread, selling a put spread, because your call spread might be too expensive. And that's all part of the math that we're going to be going into in one of our Saturday trainings. No, not even looking at any of that, MM. I'm looking at what the price is doing. Now, obviously, yes, you do have that loss over the next few weeks, but that's all built into the calculation of what is your underlying price going to do, stock price going to do during that time. CP, no. Do whatever is feasible. Sometimes when I look at a spread, I'm looking at the 50, 55. When I think the stock price could go to 70 over the next X number of weeks. And when I look at the 50, 55, maybe it's $2.20, and that's a little bit too expensive for me. But if I look at the 50, 60, that might be $3.80, so that makes more sense because I don't want to pay any more than $4 for that $10 spread. So, and again, that's all up to each individual's personal risk factor. So here's what your trade looks like on Thinkorswim. Oh, I don't know whether I've got a screen. I've got to remember what screen this was. This is what your screen looks like. It's showing all the different strike prices and what the bid and the ask is. So I want to do let's say I want to do a spread on something. Well, all I do is I click on one price, and let's say the 83 price, whoops, the 81 price, and then I scroll the other one to the 83.50. So that's $2.50, and they're asking 91 cents for that. Now, on my calculation of not paying any more than $2 for a $5 spread on $3.50, it should be, I can't even figure that out. I don't know, what is that saying? But so if I buy the 81, sell the 83.50s for 91 cents, if it goes up through the 83.50 level at expiration, goes to $2.50, I've made $1.59 or 175% profit. And my break even was at 81.91. Because on expiration day, if the stock is traded at 81.91, obviously this one's going to be worthless, but I can sell this one for 91 cents, which is what my break even is. All right, so is that right? On 350, it's $1. So that, if that's the case, 50. I think it's a little bit bigger than that, isn't it, Jeremiah? What's 0.8 times 350? Is that the right figure? Yeah, on 250 it'd be $1. On 350 it'd probably be about $1.35 or so. All right, so let's say I think it could get to 85. So what's my next solution? Maybe I go up to an 83.85, and that's 27 cents. Now, if it goes to 85 or greater, that is a $2 price, or by 27 cents is now gone to $2, or that profit, 640%. So what's my risk factor? Well, I lose the whole 27 cents if it doesn't even get up to 83. So I have to get up to 83 and then get to 83.27 just to break even. Oh, was I on a 250? You're absolutely right. I'm thinking 350. All right, so you're right. 250 it'd be $1. So that's under $1 parameters. All right, so this is where you use your spread. If this is wave 1, this is a J-hook pattern breakout, and wave 3 is up here. Now I have to look to see, is it more feasible to buy calls at this level, or am I better off just buying a spread, which means less money, the price doesn't have to move as far, and the percentage of return is much greater. So if I've got something where I've bought something here, there's my best friend breakout, and I'm thinking now that's kind of a little boost again at the breakout level. I'm making profits on these. Now I'm going to enhance my returns by doing a spread up here. So this is the advantage we have with a spread, and I don't know what I did with this stuff. Oh, there was something here. Now, so if I bought the at 205, 143% profit. But if I bought the 25 and sold the 30 for $1.35, and it went up to $5, obviously that's a much greater profit. So we were doing that right now on, do you have to wait to expiration to get the full return? Gents, no. Let's try to find a chart that we could, let's use this one. Let's say we bought a spread, and I'm going to use, I can't see these numbers. I'm going to use let's say we bought a 60.65 for 80 cents. And it went up through our 65, and so now it's gone to let's say hypothetically, it's gone to 460, and there's still a week and a half to expiration. So now my next decision is, do I want to hang on to this trade for another week and a half to have my 460 go to $5? Or do I want to just go ahead and take my profits right now at 460 and move on to something else? Yeah. Now you could also, Bill, the answer to that is no expiration. However, I've had times where, let's say we're still 4 days away from expiration, and we had bought the 60, sold the 65s, and the stock's trading at 71. Well, there's a good possibility that you might see the options trading at $5 and sometimes even greater than that, just because of the difference in the price. So you can get out your full price days before expiration. But the true expiration will be on, or the true full price will be on expiration day, because there's no premium left in either one of them. If it's trading at 65, that means those calls are trading right at 65 with no premium, and the other ones are zero. Oh, I was just using this as an example that if this was my wave 1, from this level, wave 3 could take you up to the $75 area. Wave 1, wave 2, wave 3 use the same magnitude as wave 1. Does it mean it's going to get there? No, but it's got a good probability. That's what this J-hook pattern is going to be indicating. All right, so in this last week, we had the message on Murin. Came up, pulled back, big breakout, and then started back up. We were buying the spread, the 10, and buying the 10 and selling the 12.5 for 75 cents. So all I had to do at that point was move up to the this level, which was feasible, and your 75 cents would go to 250. Now, if it gets sold off, what's that do for you or do to you? Instead of losing a full price of, or a big percentage of your option price, because both of them are moving in the same direction, when it pulled back to this level, maybe you're not, you still got, today it was at 35 cents. So you paid 75 cents, it pulled back quite a bit, you get 35 cents back. So you don't get obliterated if all of them goes the other way. Now, the other side of the coin is you buy at 35 cents here because what is our pattern recognition? A message. And what's that message usually tell us? There's going to be more upside, like a trend. So if you buy the 10s and sell the 12.5s for 35 cents, now it has to move up to this level to break even. And if it does come up to the top of the channel, now your 35 cents goes to 250, and you didn't have a whole heck of a lot of money exposed to that trade. So again, here's why people don't like spreads. Because they say, what if the stock price skyrockets? Boy, I'm in a spread, and I could have made 22 bucks on that option, and I only made $5 because of the spread. Or if the stock price moves inordinately fast, you could have made a quick profit. But the reality is, the prices don't skyrocket a whole heck of a lot, meaning, fortunately, we can find some. But if I see something that's moving real big, and it looks like it's got further to go up, and I don't want to be real exposed, put a spread on. Because if it continues to move in the right direction, I'm still going to make a good percentage return, and I don't have as much money exposed to the trade. And those are the type of things we're going to kind of walk through on Saturday. So remember, the spread has less money exposed to risk, to market risk. The percentage return is much greater. And then the price target doesn't have to go nearly as much as if you bought the option price outright. And then your break even is much lower. So the one major factor is you do the math. That's the thing we teach in our options training is You just don't go out and buy a call because the stock's going up. You got to do the math to see what is the potential target, what's the strength of the signal or the pattern, and what is the time frame. It's an hour on Saturday. We're going to be going more into which strike prices and which expiration date, or how far out you might want to go on calls and puts. And then we're just trying to get everybody oriented. We get a lot of people saying, I don't know too much about options. So we're going to be doing, these are kind of basic. And then we're going to take all this, and probably in 2 or 3 weeks, we will do a full day training on the different strategies where you minimize your risk and optimize your profitability based upon option strategies that make sense. It's always more than an hour, but so here's the October 2nd, starting at 10 a.m. That's so the West Coast has a little time to sleep in. Can't you roll options on a high flying? You can, but if there's a high flying stock, let me go back up here a ways. If I've got calls and I'm making big money, and now it gaps up through the, and I'm thinking, well, I got huge profits. I don't want this to turn around. What do I do to mitigate my risk? I close out my huge profit trade, and then I put on a spread that if it continues higher, I'm still making money. If it doesn't, yeah, the spread's not going to lose a whole heck of a lot of money. Can't you roll the option on? Yes. You can always get, if you get to an expiration day, if you've got calls and you think it's going higher, yeah, you can roll from October to November or whatever time frame. Don't you pay attention to implied volatility? No. Because remember what happens with implied volatility. The factor for implied volatility for this has nothing to do with this. That's why we don't pay attention to any of the Greeks, because we're looking at things that have a calculated price move that's going to be much stronger than just a normal uptrending stock or in its normal trading. We're looking for that timing aspect that tells us, oops, there's another strong price move. It doesn't matter what the Greeks are. Okay. At what point do you close out a spread if it starts going against you? Same scenario of any option trade. The reason you put that option trade on was because of the underlying price movement of the stock. The option is just a method for owning that stock. So logic says if the stock is starting to turn around and go the other way, you close out your option trade, because that's the piece of paper that's controlling that stock price. Is it better to put on spreads on a more expensive stock? Yes. And I also put on spreads that if I was looking at Amazon and I'm thinking, oh, I want to buy some calls on Amazon, but their calls are $37, and to go way out where something that I could really afford, I've got to go out another 100 points. Well, maybe I'm better off buying, I can't even remember where it's trading, but maybe buying the 1800s and selling the 1820s as a spread, so that I've got $4.40 into that trade. Now if it goes up through when I say 18.20, my 440 now goes to 20 bucks. I didn't have to put out 37 bucks for one option. But if the option is expensive when you buy and the 4 goes down, even though it goes your way, you can lose money. But if the option is expensive, yes. Yes, so on an expensive, oh, the volatility. Oh, yeah, but that's in any case. So if elephants could fly, they'd be damn big birds. If you're buying a stock because you expect it to have a price move, if it slows down, then you have to calculate, do I close out this trade? It wouldn't be a decision based upon the volatility. It'd be a decision based upon the prices slowing down. No, the volatility has nothing to do with what you're looking at as far as the reason you bought that stock price. I'm buying this stock price because it broke out and I expect it to do this. If all of a sudden I start seeing it do this, then it's not doing what I expected, I'm going to close out the trade. All right. Oh yeah, that's always the case too. That's why if I see something move big, I'm more apt to put on a spread versus buying the calls. Okay, I'm going to try this, Jim. Oh, any more questions on options? Which, if you got them, that's what the Saturday session will be good for. A spread balances out the Greeks, volatility, and many other factors. There you go, Bill. And so you're going to get more than your money's worth. Do you do a lot of spreads in your options room? Yes. I probably do, on an average, 60 to 80% of my trades are spreads. Some of those spreads are because I can't afford the option prices. Some of them are the price has moved up pretty good. It's doing a J-hook pattern. It looks like it's going to move up some more, but it's up in a higher risk area. I'll put on a spread. Sometimes I've got a fry pan bottom moving up nicely. My calls are working very well, and I anticipate it's going up further, but instead of buying more calls, now that it's moved up in price, I'll start adding inexpensive spreads, anticipating more upside. Oh, Jeremiah, that's way too, oh. On a credit spread, I look at it and say, all right, if I can sell this and put a good chunk of money in my pocket, what are the probabilities it's going to stay there? Sometimes, yeah, so there's not a percentage on that calculation. Should you look at options that great volume and open interest are at least over 100, 200? Yeah. If I'm looking at let's see if I can. I'm going to see if I can do something here. BRKR was a good put trade. I'm going to get rid of this. Something's not working here. What is it? Oh, it's this. Let me go back a step here. Nope, that's not what I want. I want this. Not too many days ago, recommended shorting BRKR because of this breakdown. Looks like a Barry's J-hook pattern. Great trade. However, whoops, I keep hitting the wrong thing. Look at the open interest on the puts. There's just nothing there. And you can see some of the puts didn't even trade, most of them, but all the puts didn't even trade today. So it makes it very difficult to get in and out. So investing is like anything else. No matter what good trade you see, if you can't figure out how to get in it or make money with it, there's no sense doing it. Go on to something where you can find a good trade and a good way to make money with it. Our notes, so it varies all the time. Sometimes make good money on a $10 stock. Sometimes it's a $150 stock. Oh, a butterfly spread I don't even pay attention to because that takes too much time and effort to figure out what you want to do with that. It's like my stock analysis every night. I do not want to be spending an hour figuring out what to do with trades. I want to have all my ideas done in 20 minutes. That means if I see a good stock for a put or a call, I don't want to be sitting there for another 30 minutes doing a strategy to get into that trade. I want to spend 3 minutes figuring out what to do with that trade. John, that's each individual's risk factor. What determines whether you buy in the money, at the money, or out of the money depends on what your risk factor is. If you're trading a $600,000 account and you've got $60,000 in options, maybe you're trading less out of the money, that you're a little bit more conservative, that you're trading more in the money options. So that's up to each individual. The bid and ask spread is way too far apart. That tells you there's low volume, and that will be indicated. First of all, if you see they're bidding 320 and they're asking 480, you can pretty much look to the right and see, well, there's only 80 options open interest and they only trade 10 a day. That means you're going to have a hard time getting in and out of that trade. Go on to something else. I like to see the volume or the open interest well over 500, and you're seeing options traded today, so you can get in and out pretty easy. Yeah, you're gonna, with the spread that big, you're gonna be trading with the market maker. Again, no delta. With candlesticks, you are not even concerned with delta. You're concerned with what the next price move will be, and that has nothing to do with what the delta is. Is credit spread call or put? Either or, Edwin. We'll go through that on probably not this Saturday, but in a couple of weeks of, and again, a credit spread is you're selling I'm not even going to explain it without paper in front of us. But you're putting money in your pocket and then hoping that that trade stays where the money stays in your pocket. Why would the market maker set the spread so wide? Because he's got the same problem you have. If there's no volume and he is selling you the spread at 480 and he wants to get out of it, he's got to find a buyer. There may not be any buyers around. So that's so if somebody's ready to buy, he wants to have some room to make sure he's protected if he's selling it to you. That's how they buy boats. That's right. Okay, so as you can see, the open interest on this is pretty small. Now, while I'm here, I'm going to go up, right up here, and I'm going to type in, because we looked at this one today, Murin. And so this is what your scale looks like, or your what they call your ladder. So if I want to buy the 10 and sell the 12 and a halves, I click on this, I put buy, there's up here off the screen it says vertical. And as soon as the vertical comes up, there's buying the 10s and selling the 12 and a halves, and they're telling me they can do it for 35 cents. So I click confirm and send. Now they're working on getting that trade done at 35 cents. And we'll go through that for the weekend. All right, so let's take a gander here at the markets. This is where your first analysis comes into play. And once we saw the reversal and the close below the T-line, what's our assumption? The assumption is we're heading lower. You add the NASDAQ to that analysis, where the alert on this was bullish candles, then they gap it down at the low end of that last bullish candle. What should that tell you immediately? It tells you the bears are starting to take control. You want to definitely be out of any, or start looking to close out long positions that aren't performing well. And then when they gapped it down, what do you got going on? You got your bearish best friend, bearish flutter kicker signal. What's that imply? That there's a lot of force to the downside. Now, why is that important to know? Because yesterday they opened it up here and traded up here. If I was short something, I'm sitting here sweating bullets if I didn't know that there was already a strong sell force. That's why a few people said, oh, should we cover our shorts? And just be patient. We're still in a downtrend. Same thing today. Opened up, traded up a little bit, but then the bears took control again and headed back down. Try to make a little money consistently based. Yes, that's where a credit spread program works well. Yeah, that's the fallacy now of they can give you option or stock and option trades for free, no commission. Well, if you look at your option prices, for example, you might see an option where they're bidding $2 and asking $2.20. Well, probably the real market that they're not showing you is right around 210, maybe 208 bid, 212 ask. Well, you want to buy, so they give it to you for 215, still below the 220. You think you got a deal. Well, probably the true market was at 212. You just paid 3 whatever in commission. It just didn't. So the one thing you should observe is once they went to a no commission basis, the bid-ask spreads kind of widened a little bit. Nash, yes, but this is still an indication that the bears are in control, that you're probably not in an uptrend. Now, we did a entry strategy session not too long ago, and this is the type of thing where if you see something open up, this was going to be a good trade. Had it opened up positive and started trading positive, there was your bullish slitter kicker. But this is why the color of the candle is very important. Kind of hovered here and then started selling off. What did that tell you? Well, they aren't buying yet, so you don't buy yet. Still selling off, not buying it, not buying it. You wouldn't have executed this trade today because it opened and didn't start trading higher and started selling off. On the other hand, if you did get into something where they opened it and did exactly what you'd expect it to do, after a morning star signal bouncing off the 200-day moving average and now gapping up through the T-line, coming out of the oversold area, this is a perfect place to be buying. But remember your 30% factor, that about 30% of your trades might not work. So where would you put your stop if it was trading up here and the market looked like it was getting a little bit queasy? It shouldn't come back down through the open, because when they opened it and traded positive, what did that indicate? The bulls were in control. When they came back down through the open, what did that indicate? The bulls weren't in the control anymore. The bears were. You close out the trade. So even your strongest trades, I mean, there was your kicker signal, J-hook pattern. I'm getting ready to buy on positive trading, and they gap it down. That tells you to stay away from that one. Also, 2+2 analysis that I kind of did in the YouTube tonight was the China stocks are picking up a little bit of steam. Our recommendation of ATHM is working nicely after a series of dojis. Wave 1, Wave 2, going into Wave 3, came up through the 50. Good move. And it's a China-related stock. So how do you put that into your analysis? Well, we were short Bigalow. Bigalow had a nice failure here at the 50. Kind of an evening star signal. But today, like some of the other China stocks, it was trading positive. What do you do? Oh, it's the same thing that you get in the Thursday or Monday night newsletter. I just put it out on YouTube so that I can record it and put it in the newsletter. So if you get the member newsletter or the Monday or Thursday session, that's the same one. Do you trade through earnings or around earnings? Yes, if I can see what's happening in the stock price. Meaning, if they're selling it off hard, going into earnings that's going to come out that afternoon, I'm closing out the trade, because usually that means somebody that knows more than I do is getting rid of it before earnings. Let's get out of that trade. So back to 2+2, if we know the China stocks are trading positive and we see a bullish harami near the oversold area, what's that say about our probability factor? It says we probably want to close this out and move on to something that doesn't have a bullish sentiment to it. Okay, and here's an example that I wanted to study. Remember when somebody came out last week and upgraded oil stocks? right about here. And so my question always is, how come they're upgrading the stock here? If these are clever analysts, why weren't they recommending stocks here? And that's where we have a great advantage to see what people are actually doing, not what everybody is professing is a good time to buy. Then notice what happened right after they recommended this. That's when the selling starts. What percent over the first price leg of a bull call spread should the second leg be? I have no idea what that means, Zook. No idea. What percent over? No idea. Okay. So there were good stocks still trading, or stocks trading up. Vet, ever since it came out of that best friend J-hook pattern. Percent between the bid and ask. You're not using a bid and ask on a spread. They already do that for you. They're telling you what they can buy and buy one side and sell the other and what the net is going to be for you. So when we looked at the Murin one, the 10, 12 and a halves at 35 cents, that's where they can do it. There's no bid ask. That is the price they're going to do it or try to do it. So you can see that with the best friend J-hook pattern, strong up move. But what did this tell you right here? Exuberance. If you're long this one, where's your logical stop loss level? It shouldn't come back down through today's open. As a matter of fact, if it opened lower tomorrow, I'd probably be taking off at least half the position. We saw that the shipping stocks acted well. And this was, I gave an illustration in this afternoon's newsletter that look at the gap up, and look what it did today when the market was down huge. They were still buying this. That's what the gap ups tell us. And that's the same thing on the bearish side. Oh, no. There's your hanging man. Gap down. Doji, gap down. Gap down. That tells you there's a lot of force to the downside. Let's see, DSKE was the other one we had recommended. Didn't pull back too much today. It was relatively flat. AMEH. Here's a perfect example, too, of setting your stop below the T-line, because after trading up, when it came down through there, tell you about your trajectory. There's no buying going on here. You should have closed this trade out. Now, QuantumScape, kind of the same scenario. So I'm giving this one more day. If this opens lower and starts trading lower, I'll close it out. Can always buy it back on the next buy signal. And blue didn't sell off too much. It's still in this big fry pan bottom. You could still get ready to buy this one on positive trading, especially if they can get up through the 50. Let me make this smaller. If they get up through the 50, that's right where this pattern started breaking out, or started. Now on the short side, we would recommended this one because of the kicker type failure, not a kicker type, but a methods falling. Notice where they took it up, but couldn't get back up above this level, and then sold it off. That told us they were probably going to the 50. Now, did we think it was going to go to the 50 today? No, but that was the first good target, and we're heading in the right direction. So something like this looks like it's going to be a very J-hook pattern heading for this direction. Now this one might be something where you say, all right, not a huge percentage move to get down there, so maybe we put on a bearish spread down in this level. Let's see, we did net getting toward the oversold area. It can still, if you're short, you stay short, but you put your safety stop at today's high. It shouldn't come up through there. That would tell you that's where the bears are stepping in. The biggies, like Tesla, just kind of lollygagging in here. Apple, you still want to stay short. Here's an example of why you use the T-line. They opened lower, traded up, looked a little bit bullish, then sold off. Next day they traded it up, sold it off. Next day they gapped it up, meaning today, still failed at the T-line and sold off. This is where I've discovered that I can sit through the anxious moments in the morning because I know as long as they don't close above the T-line, the prevailing sell signal is still going to be still in a downtrend. I just found you on YouTube. How do I get on that email list? I think there's a button on there somewhere that lets you sign up. Amazon, the bearish kicker signal, and they didn't hold the 200, you stay short on this one. And NVIDIA, the double bearish flutter kicker. Gap down. Anytime you see that gap down below the previous day's open, close it. Close it right away. Yeah, that's in my backyard, WB. That's why I've got this rich gold and bronze tan. And then that's usually a strong selling indication. All right, let's take a gander. Look good. That looks like it could get ready to go short. I'm trying to find some that that's your bullish flutter kicker signal. Down day, gap up doji, go positive. You can still be buying this one because now you got a scoop type pattern with a bullish flutter kicker starting to the upside. Mike, hold on to your individual ones until I tell Jim to do the double line. When you say stay short, does that mean you can go short if not already in it? Boy. Usually when I say stay short, yeah, you probably don't want to be shorting it at that time. Or if you're shorting it, you better be a little bit more diligent as far as placing a fairly close stop. Lucid was another one that a lot of people in the chat room have been following. But today, when it opened positive and did a bearish left-right combo, what's that tell you? Just a very simple process of human nature. If this is your first uptrend and they tried to take it up a second time and fail, everybody sees they fail, they start bailing out. How far do you? I usually try to stick around 2 to 3 weeks. Closer to 3 weeks if I'm buying calls outright. and then my spreads are somewhere around 2 to 3 weeks out. Because I don't want to go too far out because I'm buying what the price movements are doing today. We don't know what's going to happen 2 or 3 weeks down the road. Okay, all right. OG, J-hook pattern, backed off quite a bit. Now, what is that backing off? That's profit taking. J-hook pattern. So what's the logic here? If it opens positive and starts trading positive, it tells you the profit taking's over. On NVIDIA, the gap down 4 days ago, do you call it a gap based upon the close and the next open for a bearish candle? You're talking about this one right here or this one? This one right here is a gap down. It closed here and they opened it below the previous day's open. It gapped down. That's a very, very bearish sign. Then they gapped it down again. That tells you not only were they trying to get out, but they're trying to get out with great enthusiasm. And so you're not in the oversold area yet. If I was short, I'd stay short, but now I'd have a safety stop here at the 50 after today's signal. I want to see it open lower and trade lower. MNSO, there's your, did I say that? MNSO, yes. Nice fry pan bottom, breaking out through the 50. Now, what do we see? We see the fry pan bottom. What does 99.998% of all the other people in the world look for? They're seeing it breaking out through the 50. We know we could be buying right here because the probability is it's going to go much higher from this point. Blue Apron. Notice how when it came up through the 50, then it did a morning star signal. Now, a morning star signal is more effective, obviously, down in the oversold area. But the fact that you can see that they did profit taking, indecision, and bullish confirmation, a morning star type signal, tells you the bulls are still in control of that trend. ANGO, there's your best friend gap up. Somebody was asking whether you would call this a cradle pattern. Not necessarily, but I mean, you can see that it's a cradle pattern setup with kind of a flat bed, but then a whipsaw. That's usually a good indication there's going to be more upside. That is got the makings of a, or kind of the elements of a cradle pattern. Now, Space did a kicker signal today, but in a very bad market. So if you're thinking about buying this, you definitely need to see positive trading tomorrow in this one. Janko, almost a kicker signal. Which one had the kicker signal? USIQ, almost a kicker signal. So the solars are acting well, and LAC, Lithium American, that's got pretty close to a kicker signal. So you could still be buying this one on positive trading. Okay, on the other side, let's see what I did with this one. This one, you can see how it's rolling over. You could be shorting this if it comes down through yesterday's close. There was a failure in Bath and Body Works. Where's your likely target? Remember, the bigger the signal, the more compelling that the bears have taken control. Love, you can see up here, doji, hanging man doji, gap down. Now a good strong downtrend. You're probably heading for the 200. Oh, that's We did this one. This one looks like a bearish J-hook pattern with this being the target. That's Nucor. The retailers got whacked today. Macy's. There's your bearish engulfing gap down. I would suspect they're coming down to the 50. Nordstrom's gap down. So these gap downs obviously tell you that they're trying to get out of these stocks with great enthusiasm after sell signals. The gap, more downside. TJ Maxx. So here's another indicator. You see a whole sector being sold off. That means they're selling that whole sector off. Just a little bit more. Please show more examples where we can use spreads. We'd have to take more time. Now, on some of these, you could be doing spreads, anticipating there's going to be more downside. Foot Locker. There's your bearish best friend breaking through this level. Look for wave 1, wave 2, wave 3 in progress. And ASO, another one. Now this one, if it opened lower, I'd probably be more apt to do a spread here, because look where you are. You're already in the oversold area. A dumpling top that if they break this level, they're probably heading down here. So that'd be a good place to do a bearish spread, or a put spread. Is it BGFY? Whoops. Oh, I goofed that one up. AMKR, bearish J-hook pattern. Where do you think they're heading? Wave 3 down here. Yeah, I just forgot to add those coals. Whoops. But those horses are already out of the barn. And that's a big, hefty move. Same scenario over here on Bed Bath & Beyond. Now, this is one where if you were short, you would have just stayed short, because where do most people sell? They panic sell at the bottom. That was what I was looking for. BGFY. No. That's because I did it wrong again. BGFV. That one is probably heading down here to the 200. CarMax, big bearish kicker signal. That usually carries a lot of force more to the downside. GTHX broke this level, and observe the obvious. Where did they do it? A failure right here at the 50. And I think there was a bunch more. Williams-Sonoma. Best friend gap down. At least there's your first target. Now, obviously, they're selling off. And then you add the prospects that these markets are still heading lower. People are going to be selling off the weak ones. Are you recording this webinar? Victor, yes. We record all these. To short a stock, Nucor, using a spread, do you buy a put? Yeah, if you're doing a bearish spread. Let's just take a quick gander here. Which one were we looking at? Can't even remember from the time I read it to the new core. Okay, thank you. The brain like a sieve. All right, let's get rid of this one and get rid of this. So if the stock is trading at 98.50, first of all, I look over here. Big open interest here, but no volume today. Big open interest here, but no volume. So that's the problem with some stocks is you just don't have enough volume because if you tried to sell these and buy these, as few as that are trading, you might not have anybody selling any, and anybody tried to sell here and anybody tried to buy here, so it makes it difficult to try to get into a position. Yeah, it looks like the Dow futures are down 190, and the NASDAQ or the Qs are down $1.32. So looks like more downside. Okay, I guess that's about all I got. Any general questions? Yeah, Nash, that is what the Japanese race traders tell us where most people sell. They panic sell at the bottom. Which one was that? Fed bonds. But this is where the smart money knows what's going on, and then everybody else says, "Ah, get me out." What is the target on the NASDAQ? I'm guessing possibly all the way down here to the 200. All right, Jim, I guess go ahead and do the double line. And in 3.6 seconds, do the next double line. Bristol Myers. That one looked like it was trying to come up, and they sold it off again. Stay short. MDB bounced up, hit the T-line. I'd stay short until you see a confirmed buy signal. PROG, you can be buying this one on positive trading tomorrow now that it's come up through the 50. AUPH, you can go short on weakness tomorrow. Matador, stay long, but put your safety stop at today's low. Same thing on Callan. Notice you might have a tweezer top up here. So put a safety stop in place. Charles Schwab selling off. Anytime you see the financials and the brokerages selling off, that means the market is selling off. That's Goldman. Ew, that's a toughie. Travelers, if you're short, stay short. Okay, thank you. Maybe that's what brought the whole sector down. Myrna, just stay short. I'd have a safety stop above today's high. There's your long-legged doji in the oversold area. Kath, if I was short this, boy, I would probably get ready to start buying on any positive trading tomorrow. I can't see where it closed down here. I'd put a buy stop somewhere up here. They shouldn't be moving in that direction. Boeing, this is just kind of a junky chart. I wouldn't be long or short this one. Gold was trading up pretty good today. The gold ETF came up, but it's not a reversal signal. It's probably going to have some upside, but remember, anytime you don't see a reversal signal, you want to be a little bit more attentive at the first resistance level. Facebook, you just stay short until you see a buy signal. And Myra, another one where you've got the doji harami, not quite in the oversold area, so use your doji rule. I'd probably have a safety stop if I was short just above today's high. We did GLD. NIO is kind of flat. Right now I wouldn't be long or short. And EVH, boy, that one you stay long, but remember your simple equation, where do most people buy? They start buying exuberantly at the top. I would at least have my safety stop at today's open. It shouldn't come back through that level. Corn did a long-legged doji today. I guess it was a crop report. Soybeans got hit pretty hard. Uh-oh. Soybeans were down like 28 cents. A lot more crops out there. Yeah, it looked like it was McCormick was down near the lower end of the range. Very, that's kind of your J-hook type pattern. If you want to buy this, I'm not advocating buying a whole lot of aggressive trades on the bullish side with the market the way it is. But if you like this one, you could be buying it on positive trading and then put your stop at the T line. And blue stopped its down move. You can get ready to buy this back if you closed it out yesterday. Okay. Guess that's all we got for tonight. Just be aware that that kicker signal is a lot of force to the downside, and it looks like they're going to be opening it lower again tomorrow. All right, everybody, have a good evening. Remember, Saturday, you don't even have to get out of your pajamas. We'll just do an hour free going through the different mechanisms. Oh, or it's, I don't know how to get there. I get him to the YouTube. And you get the YouTube if you're getting the new afternoon newsletter. The YouTube is in there. All right, everybody. See you bright and early tomorrow morning.